Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the mountain of corporate filings that come across our desks, and sometimes it feels like decoding a secret message from the future. But today we actually have a message that sort of feels that way because this filing is all about a company that is literally planning for the future. This is CP Acquisition Corp, and they are filing to go public offering a stack of units, and it's pretty clear from the get-go that this is not your everyday company. They're essentially a blank check company, a SPAC, and they're not selling widgets or software. They're selling the idea of a future business combination, like a promise of a business to come. So what does this promise look like financially, and what are the risks of buying into that promise? So the very first thing to understand is that when you buy into this offering, you're not buying just one thing, you're buying a unit. And that unit is made up of two parts of Class A ordinary share and something called a share right. Now, separating these two from each other is a bit like separating the yolk from the white of an egg. You can do it, but you have to know how. This is important because for tax purposes, you'll need to figure out how much of the price you paid for the unit goes to the share and how much goes to the right, and no one is going to tell you exactly how to do that. You have to figure it out, which honestly sounds like a headache. The government is watching to see how you figure this out, and they might disagree with your calculation, which could lead to some unexpected tax bills. Now let's dive into the numbers from the financial tables. This is where the rubber meets the road, even for a company that's mostly planning for the road ahead. We're looking at some projections here assuming different redemption levels for their shares. At the highest redemption level, which is the maximum redemption scenario, and assuming the underwriters exercise their full over allotment option, the net tangible book value per share, or adjusted NTBPs, if you want to sound fancy, could drop to as low as 14 cents. Now this is diluted significantly from the $10 offering price per unit. This means that out of every $10 you put in, you might only be left with about 14 cents of tangible assets per share in the worst case scenario for redemptions. If the over-allotment option is exercised and redemptions are at their maximum, that's a whopping 86-cent drop in the tangible book value per share from the initial $10 offering price. If no over-allotment is exercised and redemptions are at max, it is a 63-cent drop. This paints a stark picture of potential dilution for investors if a lot of shareholders decide to cash out. And remember, as of the 7th of July, this company reported a net tangible book value deficit before this offering of over $30,000. That's not a lot of tangible assets to begin with, so any significant redemptions by shareholders before they even find that future business could really eat into that already slim tangible value. Now let's talk about who's really in charge here before any business combination happens. The filing makes it clear that the initial shareholders, including their sponsor, will own a significant chunk of the company's shares, about 30%. More importantly, before a business combination wraps up, only holders of Class B ordinary shares will have the right to vote on appointing or removing directors. That means the people who put up the initial seed money get to pick the board that finds the future business. Now that's not necessarily a bad thing, they have skin in the game, but it does mean public shareholders have very little say in leadership until after the deal is done. This is a critical point investors need to grasp. The sponsor bought their founding shares for pennies, literally fractions of a cent per share. This structure allows them to potentially make a huge profit even if the company's stock price after a business combination is a fraction of the initial offering price. For example, if the stock is around 39 cents, our sponsor could still make back all of their initial investment. This creates a strong incentive for them to get any deal done rather than necessarily the best deal for public shareholders. The filing itself flags this as a major risk, saying the sponsor is likely to make a substantial profit, even if the business combination causes our ordinary shares to materially decline. That's quite the admission. And here is another interesting tidbit. The company is not prohibited from merging with a business that's already connected to their sponsor or even their officers and directors. Now they do say they would get an opinion from an independent investment bank to ensure the deal is fair if they do this. But the very possibility raises a big red flag about potential conflicts of interest. It's like saying we promise to be fair, even though we might be a little biased. Now let's talk about the risks, and there are many. A big one is that they may not find a suitable business to combine with in the first place. They have a limited time frame to do this, and if they fail, a lot of this setup money gets returned to shareholders. But any business combination they do find could be rushed. They admit that the tight timeline could undermine their ability to get a good deal. And for you as an investor, this is your main lever. You don't get to vote on the business combination unless the company decides to hold a vote. They can actually do a deal without your direct approval. So your primary way to influence or impact your investment in a business combination is by deciding whether or not to redeem your shares for cash. That means you decide if the deal looks good by looking at your exit strategy. They also mention the Sarbanes-Oxley Act compliance. This act, of course, is all about ensuring financial reporting accuracy and internal controls. It's a big deal for public companies and for a SPAC looking to buy another company, especially a private one not used to these rules. There's a real risk that the target company won't be ready. This could mean huge extra costs and delays in getting a deal done, adding more uncertainty to an already uncertain process. So what's the bottom line here? SE Acquisition Corp is offering a chance to invest in a future deal an unknown quantity. They operate under a structure that offers considerable upside to their sponsor, even if the public shareholders end up losing money or getting a meager return. The risks are significant and clearly laid out, including substantial dilution potential, a tight deadline to find a deal, and the inherent conflicts of interest. While they are attempting to provide some safeguards with independent directors and audit committees, the core structure heavily favors the initial investors. It is a bold move offering a promise of a business rather than a proven operation, but for investors this means a gamble on the management team's ability to find and execute a profitable combination in a competitive market while navigating complex regulations and potential conflicts. The financial tables underscore just how diluted public shareholders can become, especially if redemptions are high. It really boils down to if you trust the management team's vision enough to bet on a future business they haven't even found yet. Alright, that's our breakdown of SPAC Acquisition Corp latest filing. What's your take on this SPAC and its prospects? Do you think the promise of a future business is worth the risk? Drop your thoughts in the comments below. If this deep dive into corporate finances was valuable, hitting that like button really helps us out. And of course, subscribe for more insights into the world of business and finance. Don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.